So the amount of companies in the S&P 500 right now that are trading above their 200-day moving average, and the 200-day moving average is a critical support line for most stocks and most ETFs, the amount of companies that are trading above their 200-day moving average right now is at historic lows. So take a look at this chart, and I'm going to move myself out of the way so you can see what's going on. So over here on the right-hand side, we are at 32%. So 32% of all the companies in the S&P 500 are trading above their 200-day moving average. Why are they not trading above their 200-day moving average? Well, because people are freaking out. People are selling their stocks like crazy. They're worried about the tariff stuff going on. They're worried about market valuations. And they're just worried about consumer sentiment being so low that people aren't going to go spend money out there in the economy. CEOs aren't going to expand their businesses. And the market and the economy is just going to keep going down the tubes. So in this video, we're honestly going to break down the bearish situation in the market. I know a lot of my videos are usually bullish, but we're going to break down the bearish situation in the market right now, that if this plays out, the market could go down quite a bit lower. And it's no surprise that Warren Buffett has so much money in cash right now in treasury bonds, and he didn't buy back any Berkshire Hathaway stock in 2024, indicating that the market still might be a little bit overvalued. And I get it, we are down quite a bit from all-time highs still, but the market rebounded pretty sharply off the lows that we hit a couple months ago, and everybody wants to know right now, do we buy this dip or do we keep going lower? So let's take a look at the Consumer Sentiment Index that updated as of the end of April, and you can see over here on the bottom right, we are at historic lows that we've pretty much ever seen going back all the way to 1980. So why is the Consumer Sentiment Index so low, and why does this matter? Well, let me explain. So consumer sentiment is pretty much a survey that goes around to different businesses and people, and they say, what is your sentiment on the market? What is your sentiment on the economy? Do you plan on spending money? Just how do you feel overall about the economy? You could see it's historically low. I mean, this level has only been seen just a couple times going all the way back to 1980. And the reason why this actually matters, because you're going to say, oh, well, I don't care about some stupid survey. I care about what's actually going on in the economy. So the reason why this actually matters is because, think about it. If you're not bullish about the economy, if you don't think you're going to have job stability at your job, maybe you're going to get laid off, maybe you're going to get fired because maybe the economy does actually slow down. It becomes this self-fulfilling prophecy of you spending less money. And when you spend less money because you're just less confident you can make more money, you're going to spend less money. The economy is going to slow down. You're going to buy less cars. You're going to spend less money at Home Depot. Just this trickles through the economy quite a bit. So when you understand that, you'll understand that the Consumer Sentiment Index actually does matter quite a bit. It's a self-fulfilling prophecy, like I just said. So when this number is super low, it does typically indicate actually that the market is close to a bottom, because there's just so much bearish sentiment in the market that if we have any positive catalyst like a trade deal or good inflation data or just good economic data, the market could pretty much go straight up. But it doesn't have to go straight up, and the data could keep coming in bad. And we just got Q1 2025 GDP data that came in, and it actually came in negative for the first quarter of 2025. Now, there is a few things we have to talk about regarding that data as to why the data might not actually matter as much as you think, and the data might actually be very positive and not actually negative because of the way that it was calculated and how they actually run these numbers. And when that gets realized in the market, which I think it did the day the GDP data came out, the market went down initially on the data, but then it went way up. So we're going to dig into that a little bit that not many people are really talking about, because it does matter a lot. Now, heading over here to the valuation aspect of the market, I'm going to show you two charts, and this is one of the really good ones that I like to look at here. So this chart goes all the way back to 1985, and the red line corresponds to the S&P 500, and the blue lines correspond to the price-earnings ratio level that the market would be trading at if it went down to that PE ratio. So the historical PE ratio for the S&P 500 is roughly 15 to 20, so we'll just say 17 as the middle number. You can see that we took this dip down over here, and then we went back up because, like I said, the market did rebound quite a bit. It recovered roughly half of the dip, so we're now at roughly 21, but remember, the average is roughly 17. The market is up here in this higher category, which does indicate that the market is overvalued, and the future returns going forward may not be as good as what you think. Yes, we're on the brink of this massive AI and tech revolution, but how much of that is actually priced into the stock market right now? Time is going to tell, but I like to see this PE ratio somewhere down 17 to 18, and that gives us a good entry point into the market if you plan to hold for the long run. And yeah, I get it. Like if you plan to hold for like 10, 15, 20 years, if you buy right now, I feel like the market's going to be way higher down the road. But if you want to do a shorter duration play, maybe like 1 or 2 years, investing right now, you might be surprised how low the returns could be for the next couple years because the market valuation is not down here to 15 PE ratio. The market is up here to 21. And you can see going back to 2008 when we had the GFC, which is a global financial crisis, the PE ratio on the S&P 500 went all the way down to roughly 10. Literally 10 for the PE ratio. It's absolutely crazy how cheap the market got. But look at the massive return that the market had from this bottom right here all the way to up over here. The market went pretty much straight up. Yes, there were bumps in the road. We have COVID. We had all these things going on over here, but the market overall went up quite a bit. But if we look at this period over here during the dot-com crash era, you could see the PE ratio of the S&P was up closer to 25. And take a look at how long it took you to break even on your money if you would invested right here when the PE ratio was 25. And remember, we're at 21 right now. So going all the way from the peak right here and then going to the right and then going down, it's almost 2015 when you would have broke even if you would have bought into the S&P 500 with no dividends reinvested. So think about that. 15 years of pretty much making nothing in the S&P 500. If you would have bought in at the peak right here, you would have had to held to almost 2015 to break even. Now, like I said, you're going to get dividends pretty much every single year and your return is going to be a little bit better. So we'll just say roughly 2010 is when you would have broke even, which was roughly 10 years later. That's crazy. 10 years later, 2010, 2011, we'll say 2012 actually is when you would have broke even because this big dip right here would have had to been recovered a little bit. So 2012 from 2020 is 12 years later. It would have took you to broke even when you would have invested right here. So this is why I stress so hard market valuations matter so much. And you could see when the market's closer to this 10 down here on the PE ratio, the market had a massive run off of that low right here. But now that so much is already priced into the market, we need pretty much perfection to come out with all the earnings that are coming out in Q1 of 2025 in order to support this high valuation level. And if the earnings don't come out perfect and if they don't come out great, expect the market to go down. And I know I sound super bearish right now, and you're probably wondering, like, Brandon, you're always bullish. Why are you bearish right now? Because every good investor has to look at both sides of every single argument to understand definitively, am I confident to invest in a market right now or am I not? And in just a second, I'm going to give you my personal thoughts on the market and what I really do think is going to happen going forward, weighing the bullish and the bearish situations. But we do have to do this every few videos to go through all the bearish stuff going on right now to really understand what are we going to do with the market, how are we going to invest, and how are we going to make money? Because remember, we're all here to make money. So this is a forward PE ratio for the S&P 500. And I know you're probably annoyed, like, why do you talk about PE ratio so much? Because it matters so much. It's the price divided by the earnings. It's basically saying you're paying this much and you're getting how much profit for how much money you're paying. It's crucial. But the market obviously took this dip in the beginning of 2025. And when that happened, the PE ratio went down to roughly 18, which was a pretty fair valuation for the market. But the market did rebound pretty quickly, and now the PE ratio is up here almost at 21 like we talked about earlier. So now that the market recovered so much of that dip, the market is now maybe a little bit overvalued based on this metric right here. And if we just go to the left and look historically how many times the PE ratio got to 21, one time right here and one time right here. So two other times since 1985 has the market been trading at this valuation level right now. And I get it that interest rates right now are lower than what they were over here. And when interest rates go down, that puts upward pressure on the stock market to go higher because money always wants to find the best risk-adjusted return. You could put your money into a bond and get, say, 10%, or you could put your money into the stock market and say, I'm going to get 10% too. Which one are you personally going to do? If a bond is a guaranteed 10% and the stock market is a risky 10%, nobody's going to put their money in the stock market. Everyone's going to put their money in the bond and get that guaranteed 10%. So as bond yields were falling, because over here bond yields almost went up to 20%, which is crazy, there was no demand for stocks. But as the bond yields went down, stock market PE ratios are starting to go up. But think about it. Interest rates in this period right here from 2010 to 2020 was roughly zero. They were very, very low. So when interest rates were so low and the PE ratio was roughly 17, that was a good time to buy into the market. But now the interest rates are 4.25% and the PE ratio is 21, it's not as compelling to put your money into the stock market right now. And I realize that I talk about this chart a lot, but it literally just updated right before I sent this video out, and I'm super happy it did so that we could talk about it because this chart is critical and we just have to understand this going forward. So the lighter line right here corresponds to the S&P 500. The darker line corresponds to the earnings per share going forward on the S&P 500. So as I've said a bazillion times on this channel, Earnings are the number one thing that matters for what a stock or ETF is going to do going forward. So, typically speaking, on this 10-year period, these two lines should start at the same level right here, and they should end at the same level right here. And when I was talking about this chart on earlier videos towards the end of 2024 and beginning of 2025, I was telling everybody these two lines are going to touch again. I didn't know when exactly, but I told people in my Discord, I told people on Twitter, I told people everywhere. I will bet you $1 million, literally, we will get an escrow company and I will bet you $1 million that these lines are going to touch in the next 5 years. And guess what? They ended up touching just a couple months later because the market was getting super overvalued in this time period over here. The market corrected down because of tariffs and it was just looking for a negative catalyst to go down, and it went down. But now that the market recovered a little bit, you can see the tip of my cursor is where the market's at right now. This distance from the tip of my cursor to this level right here on the earnings per share growth, this is the overvaluation level right here. Now, a critical thing that we do have to understand with this chart is that this is the forward 12 months earnings per share of the S&P 500. And remember, forward 12 months earnings per share is just an estimation of what we think the earnings per share is going to be for the 12 months going forward into the future that haven't happened yet. So there is a guess factor that goes into that, and it's not always accurate. So you could actually see forward earnings per share estimates are actually doing this little tick down right here, but I think that's a little bit too bearish, actually. I do think this trend is going to continue at the rate that it's growing at right here. So maybe the tip of my cursor right now is where we're at and not at the tip of my cursor right here. So this gap between here and here is a little bit less. But if we just do this, we take my cursor and we go to the left on this line right here, we will be trading at roughly a $5,100 S&P 500, which would indicate roughly a 10% drop from the levels right now. And I get it that most people are going to say, well, dude, the market was all the way up here. We took a massive 20% dip down. We recovered 10%, so the market's still 10% on sale. And it's totally wrong to think like that because maybe the market was 20% overvalued up here, then it fell 20% to fair value, and then the market rebounded 10% of the dip back. So now the market is maybe 10% overvalued. You have to be very careful with this stuff. Just because things are down from all-time highs, it doesn't mean that it's on sale. It just means maybe the all-time high was just an astronomically high valuation level that is not sustainable and it wasn't ever justified. And then super quick on the gross domestic product, the GDP data that just came out, we did have negative Q1 GDP, which was negative 0.3%, which indicates we are close to a recession. If we have 2 quarters of negative GDP back to back, so if Q2 of 2025 goes negative, which I don't actually think it will go negative, but if it does, we are technically in a recession because it would be this one and this one of negative GDP. Now, here's the kicker, and here's what nobody's talking about as to why the GDP data isn't actually negative, and I think it's actually positive. So let's go through this tweet that I sent out on X literally immediately after the GDP data came out, because most people were freaking out saying, oh my God, GDP is negative 0.3%. And yes, it was, but it really wasn't. And let me explain. So gross domestic product measures the total value of goods and services produced within a country. So you have to understand the formula in order to understand how this GDP data actually works. So GDP equals consumer spending plus business investment plus government spending, and then you do exports minus imports, and then you add it to all that right there. So the key here is exports minus imports. So remember, there was all these companies that were front-running tariffs, importing so much goods into America before the tariffs actually hit. So there's a massive influx of imports that came into the US in Q1 of 2025. So that skewed this massive import number to be way, way higher than what it typically is. So when you subtract our exports minus imports, let's just say arbitrary numbers, this number right here is 50, but this number right here is 100. This is going to become a negative number right here. So this negative 50 is going to be factored into this stuff right here. And that's going to drag the GDP data way down. So it's not actually as negative as what people think. So that's why it's critical to read beyond the lines and not just say, oh, negative 0.3, that's horrible for the economy. You actually have to understand how this stuff actually works. So the $1 million question is, what am I doing in my portfolio right now? And I'm going to be completely honest with you. When the market was 10% lower on this dip that we had a few weeks ago, I was buying like crazy. I was selling put options. I was taking the premium, rolling that into shares, and just generating more profit in my portfolio. I was generating that cash flow that everybody wants to get. But remember, I did not over leverage myself because the market fell back to intrinsic value. It's not like the market was on a crazy sale. Yes, some individual companies are on sale, but the market overall is not. So when there's a screaming buy out there, yes, I'll go buy it. But when there's not, I'm just going to sit on my hands and wait. And before you guys click off this video, I just want to make a bet with you right now that I bet you watching this video, trying to get information and try to make money in your portfolio, I bet you that you fall into one of these four categories of an investor right here. So you're either a brand new investor looking for a simple way to scale, or you're someone that tried stocks and options before, but you've had no luck, or you're a W-2 earner but no time to stare at tickers all day long, or you just want to generate stock option cash flow in a low risk way. 95% of the people that watch this YouTube channel and follow me on X, I can pretty much guarantee it that you're going to fall into one of these four categories right here. And if you do happen to fall into one of these categories, which I'm willing to bet that most of you guys do, you need to click the link below and do my course because it's geared to teach you exactly every single thing that you have to know with stocks and options all in a low risk way to scale your portfolio and generate cash flow. So if you want to check it out, click the link below. You could check out all the reviews here. I have dozens and dozens and dozens of reviews of people that went through it, that it totally changed your life. But if you don't want to do that, watch this video right here. It's how I do stocks and options in a low risk way. A little bit more color on it versus this video right here. See you guys there.